That's terrific. I thought that was wonderful. I think getting an insight into how central banks think about this really honestly is really valuable. All right, the next panel is looking at the use of blockchain in financial markets and the role of CBDCs. As we've heard, central banks are considering, in various forms, a new form of digital money, and there's a big conversation going on around whether we might use private issued stablecoins or CBDCs, as Mr. Jones just touched on. Our next panel is going to have a look at what's actually in the works. So please welcome Sophie Gilder. She's the Managing Director of Blockchain and Digital Assets at the Commonwealth Bank. Nigel Dobson, Banking Services Lead at the ANZ, one of the only banks in Australia to have launched a stablecoin for clients. Andreas Furche, the CEO of the digital Finance CRC, which was spearheading the research into the digitisation of digital assets in Australia. And David Lavecchi, CEO and co-founder of Canvas Digital, one of the fintech players that helped complete Australia's first foreign exchange transaction using a CBDC. And please welcome James to run this panel. Thanks very much. Thanks very much.
Thank you, ladies and gentlemen. Nigel Dobson, who was introduced by Jess, isn't with us. However, Sophie Gilder, who's sitting closest to me from the Commonwealth Bank, is here. And I just wanted to start, Sophie, by getting your immediate reaction there to what we heard from Brad Jones. Is there anything jumping out at you there in his presentation that you found particularly interesting, especially those potential savings that we might be trying to strive for as we push forward with all these complicated questions about the technology and its deployment?
Yeah, thanks, James. It was very interesting to hear those cost estimates. We've been doing a lot of work trying to determine what is the business case for tokenisation of real-world assets. It's quite hard to come up with those figures, and so it's really interesting to see that work that the central bank and their research partners have come up with. It's very aligned to what we're seeing in terms of the potential for cost savings, both in terms of operational efficiencies and also in terms of things such as more efficient application of regulatory capital. So great to hear that. I won't argue with him, and we'll get more and more refined in terms of understanding what those cost savings actually are. There's a couple of other things I thought were really interesting as well. Definitely in terms of the recent CBDC pilot, I think it was interesting what came out of that, and very interesting to see CBDCs as a complement to other forms of private money. I don't think we'll have just one form of digital currency in the future. We'll have many, and they'll have different strengths. I think the pilot brought that to light, but certainly the CBDC and wholesale in form as the preferred option at this stage is the only risk-free settlement asset. So we see a place for that, but we also see some limitations around it due to policy reasons. So it'll be different digital currencies used for different use cases, I think, that we'll see in the future.
Okay, we'll delve into some of those cost efficiencies just a little bit later in the panel with respect to some of the experiments that you've been running. But Andreas, who runs the Digital Finance Cooperative Research Centre that's been working with the RBA and the banks on the work we heard about from Brad. Any introductory thoughts on what we've just heard from Brad there on the efficiency side of things? And I'll come to some of the challenges as well.
Mm-hmm. Yeah, I think the point that this is really the next step in the evolution of the financial system is a really key, important point for us. The use of tokenization to represent like real-world assets, as we now call it, I don't think it's just a tail end to the blockchain-based cryptocurrencies. It's really a transition of what else we can do in the prevalent financial system with this kind of tool set. And in that context, the sort of savings potential for existing markets that Brad tried to estimate there is one component. The other component that is much harder to estimate, but nonetheless it's likely there, is the development of new markets once the tokenization of real-world assets is more available. And I think to get there, and we'll probably talk a bit more about that, but to get there is a lot more difficult than it might seem.
And how difficult is it, do you think, to deal with these issues that Brad has identified on liquidity, being split into different systems was one, and then this interoperability, the systems talking to each other, and as all this new infrastructure is rolled out, there's a potential to actually make the markets more risky as they get pulled into different areas, and we've had 100 years of development of financial markets where they've all come to be linked together quite seamlessly, and it's obviously a risk in sort of moving away from the incumbent systems. But what do you think about the work that you guys are doing, in your organisation and more broadly on starting to deal with those two issues on liquidity and interoperability?
Well, in the context of CBDC, I think important also to, as what Brad said, is we're not really, we don't really need to question the two-tiered banking system, right? Like that is an underlying structure that seems to work well. So therefore, the approach to move the joint kind of infrastructure between the central banks, the banks, and other financial service providers to a tokenized and real-time kind of level is really the aim that we're targeting there, and rather than a complete change and complete disruption of the system, the part of the system in particular that works well.
David, Canvas was working on the pilots with the RBA as well as Commonwealth Bank and 14 other organisations. Your sort of application was around financial exchange, FX markets, foreign exchange, and Brad put up a slide there sort of talking about FX as being one of the areas where there's some, kind of efficiencies to be found. Just sort of like simplifying things a little bit for the audience. So just tell us about the size of foreign exchange markets now, how they operate in terms of the clearing and the settlement process, and just how this experimentation with the CBDC is streamlining that process and where savings might be found in doing so.
So we were really pleased to be part of the eAUD pilot project, and we showed a use case of tokenized foreign exchange and cross-border settlement. Foreign exchange in and of itself is a multi-trillion-dollar market. It's one of the deepest markets in the world and largest markets, and it's surprisingly characterized by a lot of inefficiencies, a lot of high costs, and a lot of slow transactions. Actually, in some cases, it may be quicker to take cash out of the ATM, get on a flight and take it to another country to actually move rather than moving it using your regular bank accounts. And so when we set out to see what are the benefits and part of the eAUD project, we said using a CBDC and providing foreign exchange against a stablecoin presents an entirely new way of doing foreign exchange. And what we were able to show is that an hours-long process went down to seconds and became atomically settled across blockchain, so there was interoperability, and that money could then be moved to another bank account or used in another part of a programmable payment instantly and securely, and with a lot less counterparty risk. So the benefits are very evident as soon as you do the transaction, and it's really reinforced by the comments that we heard earlier from Brad, that this is, when you're looking at what are the applications of a CBDC and of digital currency in general, foreign exchange is one particular area, cross-border payments, where there's very demonstrable benefits in terms of efficiencies and reduced costs and more capabilities that are delivered by using blockchain.
Another area that Brad pointed to, Sophie, was fixed income markets. I think he said they were ripe for disruption, in his words just then. Could you talk to us a little bit about your thinking about bond markets and what you're doing there? And I'll come to the RBA pilot as a secondary question, which involved carbon exchange markets, but just in the area of fixed income. Obviously, these are the most massive markets in the world, and anything that's going on now is going to be extremely incremental and just around the edges and still at a pilot stage. But what do you see as the potential? I saw a slide Brad put up there, I think $4 billion it might have been of bonds issued in tokenized form in the last couple of years.
Yeah, the amount that we've seen tokenized so far in capital markets and debt capital markets in particular is tiny relative to the size of this market globally, but it's a start. So we have thought that debt capital markets is prime for a new generation of technology for a long time now. I think we did our first pilots back in 2017 in this space. So I think that it's evident that debt capital markets can be made to be much more efficient if you've got the assets tokenized on one side and you've also got the seamless settlement mechanism whatever form of digital currency that is on the other side. You do need both in order to get maximum efficiencies and to get, for example, atomic settlement and full programmability, your asset and your payment mechanism on the same rails. But if you have that, then I think that there is massive benefits. And it's not just in terms of the settlement, it's also what else you can do because it's programmable. So things, for example, like embedded compliance, where you can codify the rules such that the assets are traded as they should be. It reduces the compliance cost because you've actually embedded the rules in the market. So I think there's huge promise there. There's also lots of obstacles to overcome to actually make it happen, because the market that exists today in debt capital markets, while it hasn't really changed much in maybe 25, 30 years, it does work. So in order to get to move to the new, you sort of need a burning platform or something that pushes you in that direction, because otherwise these entities can be relatively slow to move for a lot of valid reasons. So it's really good to see that there are green shoots in terms of initial tokenisation of these assets, but there's a really long way to go before the market shifts to the new technology.
It's not surprising given the size of the bond market. But what about new markets, greenfield markets? So an example would be markets for carbon credits, markets for nature-based biodiversity credits, which are being built off new global regulation at the moment, with something more of a clean sheet of paper. One of your pilot cases with the RBA involved carbon and nature credits. Can you just tell us whether or not you saw anything there that changes the game?
Yeah, so the reason that we wanted to do a pilot of biodiversity credits as part of the RBA's CBDC pilot is we think that for greenfield markets, it's a really interesting intellectual exercise, if you like, to think if you had no market that existed today, so you don't have legacy systems to deal with, how might you build that? And one of those ingredients, not the only ingredient, but one of those ingredients would definitely be blockchain technology. So effectively, it's a thought exercise, if you like, of we've got a blank sheet of paper. We want maximum efficiency and maximum trust. How do we achieve that? And a way that you can demonstrate that is with these greenfield markets where you're not trying to compete with legacy infrastructure or integrate with that legacy infrastructure, which is always more challenging and is one of the reasons we haven't seen that wholesale shift, I think, in some other markets. So important because it's greenfield and you can demonstrate that if we were to build the financial markets today, this is the technology we would use. It's sort of a blueprint for what financial markets might have looked like if you had blockchain at your disposal when you were building them. But in addition to that, it's of course because the opportunity is huge, because nature-based assets, you can think of it as the new carbon. It's going to be a very, very large market. And so we're keen to explore how we can catalyse that.
Andreas, what jumped out at you in those pilots that have been conducted sort of this year in other areas? We can enrich registry information, track provenance. Like, what did you see in some of the other use cases that stood out here?
I think there's sort of two categories. There's the categories where we saw and evidenced in some way potential benefits along the lines of what Brad outlined in the previous presentation there, and that's markets essentially where banks or wholesalers deal with each other, where it really makes a difference whether you use central bank funds or not, and whether they're present in a tokenized form. And then there was another group of use cases where it was shown that central bank funds or bank tokenized funds could improve the market in some way or another, or basically underline new use cases, build new use cases. For those, it's probably sufficient, or that bank issued money can be supported by central bank infrastructure, like bank issued tokenized funds. And for those where wholesalers or where banks deal with each other, the central bank funds, they are really sort of required as a basis to do that. And that's the sort of two categories that I think.
So on the second category, it's quite a complicated topic to follow. So just try to unpack this a little bit for the audience. Like, how crucial is the central bank digital currency aspect of that when banks trade with each other? Okay, this idea that there might be created an eAUD, digital form of central bank money that will be provided to banks in the wholesale markets, you know, and sort of a different form of the exchange settlements accounts that already sit with the Reserve Bank. How important is the CBDC to get the efficiencies here, or can it be done by other means?
Well, wherever banks deal with each other, they only want to deal in central bank funds. I think that's the underlying issue. So then the question is, does it need to be tokenized or digitized in any other form than what the digital Australian dollar that we already have in ESAs and other forms is? And I think the answer to that is what we term CBDC is really a collection of properties that we would like to have in central bank funds that support the tokenization of trading and the financial system. Now, where we call that CBDC, whether that now has to be on a blockchain or not, or whether that we can probably narrow that down to a relatively small number of properties, which includes being able to put a partial hold on funds and other things that support atomic transactions. And that kind of thing is then what is a CBDC. So the logical next step is indeed to work out how does it fit best into the existing infrastructure that we already have. But like, you know, where we call it CBDC and what that exactly would look like, so long as it supports the properties that support the use cases, that's the main thing that we're trying to drive at there.
Okay. Are there any questions, ladies and gentlemen? If there are, please don't hesitate to raise your hand. No? Okay. We've only got a few more minutes, so stick with us. David, I'll bring you back in here. So like, just talking about your experiences with the RBA pilot, you know, relatively small size fintech company. What did you learn in terms of the regulatory licensing process that you needed to go through in order to participate in the pilot? This was sort of like a real trials, ladies and gentlemen. The RBA issued real CBDC in these trials, which meant that all the participants in them needed to go through the full regulatory process or get exemptions in order to participate in it, which provided a lot of learnings back to the Reserve Bank and to the regulators on how we might actually make this work if it does eventuate. What were your learnings from that process and how you engaged with the corporate regulator on market licensing related regulation?
We learned a lot, and as you've said, it was a real pilot and it was unique. We see on a global basis where the eAUD was an actual claim on the central bank, unlike most other CBDC pilots around the world where it's just a synthetic currency. This was an actual form of digital currency backed by the RBA. So as a result of that, all the use cases had to go through regulatory compliance and had to be fully compliant with regulations from ASIC and AUSTRAC, and went through a process of due diligence by both the DFCRC and RBA. And so when we put forward our proposed use case, it was seen that there would be potentially some aspects of the use cases, and other use cases saw this as well, that there could be properties that would suggest it would require holding an Australian financial services license, having a clearing and settlement facility, and potentially having a markets license. And there's not many entities in Australia that have those. It's really just the ASX and other major institutions. So for an innovator like us, it was very much a experience to go through and to say and to explain what we were doing in terms of our use case to ASIC, and then we were quite pleased that ASIC would give us exemptions to operate our use case within the current regulatory framework. Now that was quite challenging, yes, for a smaller company, but we did manage to engage with the regulators and ultimately lead it through to a successful use case. But what it showed us is that when you're trying to work within the current regulatory frameworks, that's very challenging. And so everything we're hearing now about regulatory change is positive, and it helps to give some clarity that would allow players like ourselves and other players really to go into this space and innovate, because ultimately yes, it's critical to have consumer protections, yes, it's critical to have market protections, but there also needs to be innovation. And you can see on a global basis that other jurisdictions, such as in Europe, we've just opened our European offices, given that there are emerging and really regimes that are in place now that are a lot more favourable, there's a lot more certainty. And so what we're seeing now from Australia is promising, but this space moves very, very quickly, and if it's not going to happen here, it's going to happen offshore. So the eAUD pilot taught us a lot, and it's really informing everything that we're doing going forward.
Andreas, I might just bring you in there on the regulatory question as well. We heard earlier today from the Minister that a lot of the crypto exchanges will come under licensing regulation. The ASIC chairman is here, ladies and gentlemen, to follow this panel on that. What are your learnings in terms of where regulation needs to go? A lot of the focus has been on consumer protection side of things. The Minister this morning was very explicit in the asset tokenisation themes being supported by wherever regulation goes. What does Treasury sort of need to look at in this tokenisation space now? They've done a token mapping exercise that was quite focused in on the speculative crypto tokens. Do you think that needs to be broadened? How do we get these sort of themes we've been discussing about here into the regulatory momentum that has started this morning?
Yeah, we really think that the big potential is in the tokenization of real-world assets, and in that context, it's good if we apply financial regulation to crypto assets if they're used as a financial instrument. But really, they're just one vertical, and in a future financial systems environment where we are using tokenization of assets and the different kinds of trading that comes with it, that's the horizontal. And there's a lot of other vertical asset classes much larger than crypto that can benefit from this kind of transition. So therefore, the regulation and focus on regulation, and whether there needs to be new regulation or otherwise, should look very strongly at those other vertical asset classes, the real-world assets, where we really have a lot to gain from moving on to tokenization. And it seems a lot of the time that the focus on crypto regulation almost distracts from what it takes or what would need to be done to give certainty to what it means if real-world assets move to tokenized form. What it shouldn't mean, for example, is just because that they're tokenized that they get regulatory treatment that's very different, or that we assume that there is no regulation for it yet when the underlying instrument that's being traded is in fact the same instrument. And I think in that context, and to this point of moving real-world assets to tokenization, I'd just like to add why it seems so bloody difficult to do it, and it's absolutely not trivial to just put things on a chain and then trade in a new form. And that's because when you move to an institutional environment, then we're really changing everything about trading in going to tokenization. We're changing workflows where we now have to do a lot of the compliance checks before transactions get done, because once a transaction is done, it's done atomically. So reversal, which is available on marketplaces like the ASX as a way to fix your errors, or post-trade settlement timeframes, they disappear. So we need completely different workflows, and anyone who's worked in that space in the banks will have had the painful experience what that means when you put fire blocks in place and all of that, and you have to have your segregation of duty already at the time of transaction decision.
Brad spoke about pre-funding as well, like quite a lot of fundamental changes.
So that's one of the dimensions. The next dimension is that we are actually changing what title is. Right? Like it's convenient in Bitcoin and these kinds of assets where there's no backing and where your title is in fact the key that you hold and there's nothing else. But if you have title regulations that's separate to wherever you register something on a blockchain or otherwise register. So you might change something, you might think you change the title when you change your holder representation. But there are still ways to challenge that later in courts. Okay, that doesn't happen in Bitcoin, but it does happen in all the real world assets. And so there's more of these kinds of issues that even the business models are changing, right? When you look at how the transaction flows in a blockchain-based and a tokenized-based environment, the transactional supporting entity in a way is the registry. So the registry is the transactional generator, and therefore that's where the business model shifts. So there's very fundamental shifts implied in this talk.
And now you've got it shifting towards the trading side of things.
The trading side almost becomes like you could almost, in an ideal tokenized environment, you could almost trade by a mathematical algorithm, because if you ensure an exchange means an immediate exchange of tokens, then the exchange venue is a lot less important than it is currently, Whereas the registry environment that now has to wear like regulatory requirements is the only place where you can enforce, where you can do compliance. That gains a lot of importance.
So the form of the asset isn't necessarily changing in a legal sense once it's tokenized. However, the markets on which it trades are changing quite fundamentally. And if you're eliminating a clearing and settlement process that takes a couple of days now and is designed in a regulatory sense to ensure that there are clearing houses and that there's enough capital held against that clearing process, if that is compressed to virtually real time, you've got a completely different nature of risk in the markets. It's more based on a technology style risk, like a technology company. It could be related to outages or technology failing. Do you sort of think that's going to need a lot of work to regulate markets in a fundamentally different way at a market licensing level?
Yeah, I guess that goes to the clearing and settlement part of it. So what you're rightly saying is, or pointing out, is that the clearing and settlement is now something that doesn't build intraday risk anymore. It doesn't build settlement risk because all transactions are inherently pre-funded in a tokenized kind of marketplace. So then that means that the kind of settlement risk that we're looking at now when we're providing a clearing and settlement license, which is, is there enough liquidity there to actually clear and settle at the end of the period, that disappears. But if this new component now, this new kind of exchange infrastructure becomes a core component of our financial infrastructure, then maybe the uptime of it itself is a risk. So you can't afford for that to go down anymore. So in that case, I think what you're saying is right. Like, you should look at whether a clearing and settlement license should be more tied to technical availability rather than to financial risk, because the financial risk is inherently avoided.
Any final comments there, Sophie, before we wrap this up on the regulatory outlook, or any learnings that you've had in the CBDC process?
Yeah, so I think the key learnings out of the RBA pilot for me were, there was really two areas. One of them was certainly the technology works, but what we really need is we need a clear rule book as to what we're allowed to do. So I think there's opportunity to learn from world best practice in terms of how we get clarity with regulators, because I know the innovators in the market are really keen to do the right thing. Absolutely no one wants to go out with a product which is not okay. And we know that regulation by enforcement that we've seen in the States is definitely not a path we want to go down. We would like to use our resources to get it right before things are even launched. So I think there's some additional scope there to work out how we can collaborate and get to clarity before products are issued. That is better for customer protection, and it's certainly a better and more fruitful allocation of resources.
Okay. If there are no questions in the room, I'm going to end this panel now. So thank you very much for speaking with me. Please join me in thanking the panel, ladies and gentlemen.